Welcome back to the Smart Feed crew. Today, we're tackling one of the biggest questions shaking the crypto world. Why is Bitcoin dropping? Again, the charts are red, the headlines are loud, and investors are nervous. But the truth is, this drop isn't random. It's the result of multiple powerful forces colliding at the same time. And today, we're breaking them down one by one. Section 1. What exactly is happening to Bitcoin? Bitcoin has fallen sharply in recent weeks, losing billions in market value. But, here's the twist. This isn't caused by a single event. It's a chain reaction, a domino effect, triggered by global markets, investor behavior, and internal crypto mechanics. Let's unpack the real reasons behind the fall. Our aim: a clear, fact-based breakdown beyond the noise. After a period of strong gains and optimism, the market shifted quickly. Many are asking, why is this happening now? The answer is complex. First, macroeconomic trends. Next, intricate market mechanics. And importantly, human psychology. These factors are interconnected, pieces of a larger puzzle. We want to cut through that emotional static and give you the knowledge to interpret market behavior yourself. It's structured to guide you in logical order. We'll start with the macro picture, then dive into crypto-specific amplifiers. One of the most significant forces weighing on Bitcoin is the challenging global economic environment. Across the world, central banks are grappling persistent inflation, slowing economic growth, a condition often called stagflation. To combat rising prices, institutions like the U.S. Federal Reserve have signaled a more hawkish stance. Interest rates may need to stay higher for longer. Higher interest rates make it more expensive to borrow money. That tends to slow economic activity. Higher rates on safer assets, like government bonds, make them more attractive, creating an incentive to reallocate capital. In a risk-off environment, investors prioritize capital preservation. They often sell speculative or volatile assets and move funds into safe havens: cash, gold, high-quality government debt. Even though Bitcoin was once called digital gold, it's now behaving more like a high-risk tech asset. Its price correlates with growth-oriented tech stocks, especially during market stress. Institutional and individual investors quickly reduce exposure. Bitcoin is often first to be sold. Think of investing as a risk spectrum. Very safe, low-return assets on one side. High-risk, potentially high-return assets like venture, EM stocks, and cryptocurrencies on the other. Tech market sell-off, the correlation problem. Bitcoin is increasingly tied to the performance of tech stocks. When tech giants fall, crypto often follows. Recent stock market volatility has spilled over into Bitcoin, amplifying the drop. Discussions about interest rates, inflation figures, and geopolitical tensions directly influence the risk appetite of big pools of capital. As long as global finance is cautious and fearful, risk assets struggle, a tide that lowers all high-risk boats. The pool of buyers shrinks, the motivation for sellers rises, putting sustained downward pressure on price regardless of fundamentals. The current drop can't be understood without this macro backdrop. Next, the hidden forces below the surface. Derivatives market stress, the hidden force. Behind the scenes, Bitcoin's derivatives market, especially options and futures, has exploded in size. Large funds, including major ETF-linked players, have been adjusting positions, hedging risks, and unwinding leverage. This creates unnatural price swings. When big players move, the entire market feels the shockwave. If spot trading is the surface of the ocean, derivatives are the deep currents that quietly shape the waves. Leverage wipeouts, the domino effect. One of the biggest contributors to Bitcoin's drop is forced liquidations. When traders borrow too much money to bet on Bitcoin rising, even a small price drop can trigger automatic sell-offs. These liquidations then push the price down further, which triggers more liquidations, which pushes the price down even more. It's a self-feeding loop, and once it starts, it's hard to stop. Cascades can involve billions of dollars in forced selling in hours. That's why we see sharp, violent downward wicks on Bitcoin charts. It's often not long-term panic selling, but automated liquidation mechanics flooding the market with sell orders faster than buyers can absorb them. This mechanism accelerates a modest downturn into a gut-wrenching plunge driven by market structure. Derivatives amplify moves, leverage converts, dips into cascades. Understanding the plumbing reduces the panic. Now, pressure from within the network. Miners. Miner selling, the pressure from within. Bitcoin miners earn BTC as rewards, but when prices fall, their profit margins shrink. To cover electricity and operational costs, miners often sell more of their holdings during downturns. This adds extra selling pressure at the worst possible time. If price dips below production costs, less efficient miners become unprofitable and may capitulate. ETF outflows and weak demand. The new market reality. Bitcoin ETFs were once the heroes of the bull run, bringing in billions, but recently inflows have slowed, and in some cases, reversed. When ETF demand weakens, Bitcoin loses a major source of buying power. This shift signals that institutional investors are becoming cautious. Large daily outflows get reported and can hurt sentiment, creating a feedback loop. This lack of persistent demand leaves the market vulnerable to other selling pressures. ETF flow data is transparent. Near real-time shifts feed into trader expectations. Now to the human layer driving momentum. Fear, headlines, and human psychology. Let's be honest, crypto is emotional. When fear spreads, people panic sell. When headlines scream, crash, more people exit the market. This creates a feedback loop where fear drives selling, and selling drives more fear. Is this the end for Bitcoin? Not even close. Bitcoin has survived crashes far worse than this. What we're seeing now is a market reset, not a collapse, a clearing of excess leverage, a recalibration of investor expectations. Historically, Bitcoin has always recovered and binds, and often stronger than before. So why is Bitcoin dropping? Because global uncertainty, derivative stress, leverage wipeouts, miner selling, ETF outflows, and investor psychology all collided at once. Understanding is the first step to navigating volatility with a clear head and steady hand. If you found this breakdown helpful, hit subscribe, and we'll meet again tomorrow with another deep dive from the Smart Feed crew.